In today's video, we'll talk about asset allocation, which simply means deciding how much of your investment money to allocate to the stock market, how much to the bonds, and how much to keep in cash. The reason for distributing your investments across different asset classes such as stocks, bonds, or cash is to manage your risk while maintaining a healthy returns on your portfolio. Historically, stocks are riskier, meaning they fluctuate more in price compared to bonds. Cash is the least risky because it does not fluctuate in price and is very liquid, allowing you to easily withdraw it for immediate needs. However, despite being riskier, stocks offer significantly higher returns than bonds and cash. And as you can see on your screen, there is a table showing the nominal and real returns of stocks, bonds, and cash from 1928 to 2021. Real returns refer to the returns adjusted for inflation. Stocks have almost double the nominal returns of bonds. In fact, the real returns on stocks, meaning the returns after inflation, are nearly 4 times higher than those of bonds. Conversely, if you keep cash in bank account or money market account, you will hardly beat inflation, as evident by the very low real returns. This demonstrates that each of these 3 asset classes has a different return and risk profiles. The higher the risk, the higher the returns. The goal of asset allocation is to create a portfolio that balances risk and returns based on your individual factors such as your age, risk tolerance, investment goals, and investment time horizon. In this video, I'll present a framework to help you decide the right asset allocation for you depending on your individual profile. My name is Kanak and welcome back to my channel. For more such content from the world of finance and investing, subscribe to my channel. And if you like this video, then do not forget to hit the like button. Before discussing the right allocation between stocks and bonds, let us first talk about the amount of cash you should hold. As we saw in our table, holding cash in your savings account or money market account will not produce any meaningful inflation-adjusted returns. Therefore, holding too much cash will hurt your portfolio returns. However, life is unpredictable and having some cash to cover your emergency expenses such as job loss, medical bills, or home and car repairs is very important. If you are still of working age, that is below the age of 50, holding 3 to 6 months of your living expenses in cash might be the right amount for you. But if you are nearing retirement or already retired, you may want to hold 12 to 18 months of your living expenses in cash. Essentially, you should hold only enough cash to cover immediate expenses and emergencies. I've created a separate video where I discuss in details how much cash to hold, and I've added the link to that video in the description below. Now let us talk about how to allocate your investments between stocks and bonds. There are 3 different asset allocation profiles that you can choose from. The first is aggressive allocation, where you invest 70 to 100% of your portfolio in stocks. The second is moderate allocation, where you invest anywhere between 40 to 70% of your portfolio in stocks. The third is conservative allocation, where you invest anywhere between 0 to 40% of your portfolio in stocks. The higher your allocation to the stock market, the higher will be the returns of your portfolio. However, stock markets are volatile, which means increased price fluctuations in your investments. So by including bonds, you can add steadiness and stability to your investment portfolio. And as you can see on your screen, Vanguard conducted a study examining the average annual returns from 1926 to 2022 for different composition of stocks and bonds. On the far left, the bar represents 100% bond allocation and 0% stock allocation, resulting in an annualized return of about 5.1%. This allocation has the least fluctuation in returns, ranging from 32.6 to minus 13.1%. On the far right, the bar represents 100% stock portfolio with the highest average annual returns of about 10.2%. However, this portfolio also has the highest fluctuation in returns, ranging from 54.2% to minus 43.1%. Now the real question is whether you should opt for an aggressive, moderate, or a conservative portfolio allocation. This decision depends on your age, risk tolerance, and your investment goals. Jack Bogle, the founder of Vanguard, suggested an interesting rule of thumb for asset allocation: holding a percentage of bonds equal to your age. For example, if you are 40 years of old, you should hold 40% in bonds. If you are 60 years old, you should hold 60% in bonds. However, you should not blindly follow this rule. Your asset allocation should depend on 4 critical factors: your age, risk tolerance, investment goals, and the current financial situation. Let us examine each of these factors individually. First, let us talk about age and investment time horizon. If you're in your 20s, 30s, or 40s and your investment goal is to save for retirement, you have a long time horizon. This means you can tolerate short-term price fluctuations because you are investing for the next 20 to 40 years. You can maximize your returns by choosing an aggressive portfolio allocation, which can range from 70 to 100% in stocks, depending on your risk tolerance. On the other hand, if you are in your 50s or 60s, close to your retirement or already retired, and your savings are your primary source of income, you might prefer a moderate asset allocation and then slowly transition into a conservative allocation. The reason to pick a moderate to conservative asset allocation is because you would want a steady income from your portfolio, and secondly, you would want a stable portfolio to be able to sell and liquidate in case of financial need. Now, one important thing to remember is that the downside of a conservative or a moderate allocation is low long-term returns. For your savings to fund your retirement of 20 to 30 years, your investment returns need to beat inflation and cover your living expenses. For a moment, let us look again at the distribution of returns by different asset allocation. For instance, if you have a conservative allocation of 70% bonds and 30% stocks, the average long-term returns might be around 7%. With an average long-term inflation rate of about 3%, your inflation-adjusted returns would be around 4%. So if you withdraw 4% from your portfolio, which is above the long-term average inflation rate, then you could possibly support your living expenses only if you have a substantial saving corpus, such as $1 million or $2 million. However, if your savings are only $500,000, a 4% withdrawal may not be entirely sufficient, and you might need a higher stock allocation to improve your portfolio returns. Because you need to cover all your living expenses for the next 20 to 30 years in retirement, you must choose your asset allocation based on your investment amount and the time period for which you plan to withdraw the money. Now, if you have your house paid off, no debt, and have another source of income such as a pension or a social security that partly or fully covers your living expenses, you have more freedom to choose a more aggressive asset allocation. In this situation, you can withstand a short-term price fluctuations without having to sell your portfolio at a loss during a market downturn. Alright, now the next very important question is, what should you invest in? The answer can be as simple as two-fund portfolio. One fund should invest in the entire US stock market and the other should invest in the entire US bond market. For stocks, you can choose US Total Stock Market Index funds such as the Vanguard Total Stock Market Index Fund with ticker symbol VTSAX, or Fidelity Total Market Index Fund with ticker symbol FSKAX, or the Schwab Total Stock Market Index Fund with ticker symbol SWTSX. All these funds do the exact same thing. They invest in almost all of the stocks listed on the US stock market, providing a well-diversified portfolio of stocks. They have similar returns and risk profile, with the primary difference being the companies that manage these funds, and they all are low cost. Similarly, for bonds, you can choose Vanguard Total Bond Market Index Fund with ticker symbol VBTLX, or Fidelity US Bond Index Fund with ticker symbol FXNAX, or Schwab US Aggregate Bond Index Fund with ticker symbol SWAGX. All these funds invest in the overall US bond market, offering a diversified portfolio of bonds at a very low cost. Now, if you want exposure to the international stock and bond markets in addition to the US market, you can add two more funds to your portfolio. The first is an international stock market index fund such as the Vanguard Total International Stock Index Fund VTIAX. VTIAX invests in all international stocks except those in the US. For bonds, you can invest in an international bond index fund like the Vanguard Total International Bond Index Fund VTABX, which invests in bonds outside the US. However, keep in mind that the US stock market has historically outperformed the international stock market. Therefore, investing in international equities may reduce your overall portfolio returns. But if your goal is to get geographical diversification, then you can choose to invest in the non-US stock and bond markets, even if it may lead to lower returns. Finally, one important thing to make sure as a long-term investor is to pick only those index funds that are low cost, because fund management fees can significantly impact your returns over the long term. So, keep your fees as low as possible. Thanks for watching till the end, and if you find this video helpful, then hit the like button and subscribe to the channel.